Hello, my name is Isaac Cryer, and in this video, I'm going to share with you my value investing strategy, and I'm going to show you how you can use options to achieve even higher returns, and how you can use options in a way like Warren Buffett and some of the greatest investors of all time. So without further ado, let's get into the video. So years ago, Warren Buffett entered a contract to buy millions of shares worth of Coca-Cola. And this contract is very similar to what everyday people like us would use as selling a put contract. And this strategy is actually less risky than just buying shares outright on the open stock market. So the strategy I'm going to be talking about today is selling put options. And before you even get started on this, I would highly recommend that you read this book, The Intelligent Investor by Benjamin Graham. And that's going to give you a foundation for what stocks you want to sell puts on. So just in a summary, you want to sell puts on stocks that ideally have a PE of less than 20, price to book of less than 2, and have twice as many assets as liabilities on their balance sheet. Once you find that company with strong fundamentals and you believe in the company long term, then it's time for the second step. Once you have enough cash in your brokerage account, you're going to want to use that cash as collateral to sell a cash secured put. I generally sell contracts with about a strike price of 5 to 10% below the market price, and I target 30 to 90 day expirations. Once you choose a contract, send the order through and collect a premium. Cash secured puts are a great strategy in my opinion because you have a much better probability of profit. For example, on Intel, by selling a contract, your break even would be $38.44 versus $43 if you just bought at market value. And most of the time, you don't even take assignment, so you're just going to keep that $156 premium. So a good way to visualize selling put options is to treat the security in question the same way you would treat a house. So let's assume that you found a house you really liked, listed at $225,000, but you only wanted to pay $220,000 for the house. Theoretically, you could sell a put option, collect $2,000 in premium, then if the housing market falls over the next 2 months, you buy the house. But if not, you just keep the premium. So as you can see, put options are a great way to collect passive income, and they actually offer a slight buffer to market downsides as well. Now let's talk about why this strategy prints money. Theta. For every day that passes, the contract loses value. But that value, since you sold the contract, is value that's going into your pocket. And I mentioned earlier that 30 to 90 days is the most optimal expiration for selling. Now that's a little bit flexible, but at 14 days or less, break-evens are lower and the risk of downside isn't justified by the premium. You can sell these, but just be prepared to take assignments and losses more often. And after 90 days, the theta decay is too slow to justify the option, in my opinion. There's one more factor to take into consideration before selling put options: volatility. Ideally, you want to sell when the volatility on the stock is high. The best way to do this is to sell a put into a substantial decline in the stock price. This is going to ensure that you collect an adequate premium for the risk you're taking on. And when in doubt, just remember, be fearful when others are greedy, and greedy when others are fearful. Well, that concludes this video, and I hope you've enjoyed. If you have any comments or questions, please feel free to leave a comment, and I'll reply to all of them. And I plan on making more future content about value investing in stocks and real estate. So, thank you for watching.